And welcome to this Danielcode webinar. And it's a pleasure to have your company. And I want to start by thanking all of those who've written to me to wish me good luck with some recent health issues, which are now all locked up, and happiness prevails. In fact, David Webb, very long-term Danielcode supporter, wrote to me a month ago to say that he viewed cataract operations as a modern miracle, and indeed they are. It's quite literally like having curtains taken from your eyes, and that's exactly what we've got here now. It's a while, as I say, since I've spoken to you. I'm delighted to see so many of you here. Would one of you please just type into the question box that you can hear me okay? That across the thousands of miles that this webinar is going, that you can hear me okay and see the screen. Anyone happy to do that? Let me see, do we have a problem? No one's saying that they can hear me okay. We might have a issue about our sound. No, we don't. Thank you, Jeff. Jeff's a farmer out in the Midwest, and thank you very much. Justin, also glad to have you with us, my friend. Wonderful, thank you. So many of you that have been such great supporters of the Danielcode for such a long time. It's an absolute delight. Well, all the fun of the fair. Some of you are going to say, well, this feels pretty cynical because trouble is brewing, and some of it's already arrived. But we're traders, and I talk to you now as traders, but bearing in mind we all feel the dreadful effects of war, which is the present conflict between Iran, the United States, and Israel are the prime participants, but of course a whole lot of both allies of Iran and allies of the US-Israel coalition are getting sucked in and feeling the burn. So let's talk about the many, many things that are happening that are to affect you and your trading very quickly. And I've headed this slide pretty simply, think. There's just a whole lot of things to think about with what's happening in the Gulf, in the Straits of Hormuz, and it affects all of us. The dramas in the oil market are everywhere. Australia is about as far away from the epicenter or our ally America as you can think. But instant panic has hit here about shortages of petrol. Petrol prices have jumped massively, and that's largely controlled by government, but they've had to acquiesce and let prices rise. And supplies of oil, of petrol for us, and diesel in particular for our farmers, is in very, very short supply, if it's available at all. And in some of our regional areas, it's not available, which is ridiculous for a modern country like Australia. But we have a ridiculous government, so you know what they say, the country always gets the government it deserves, and it's going to be a while for Australia to sort itself out from this dreadful, appalling present Labor government. Let's think about the big issues now that they don't affect Australia much, but these are the things to think about. You've got to think about what's happening in the market in this stage with what's happening in the world, because these are historic issues, and the supply of oil to the world is a very, very basic mechanism of almost all markets. So think about what's happening here in these terms. Trump and the US Energy Secretary said they considered the Straits of Hormuz as an issue and the potential for Iran, which covers at least 2 and part 3 sides of the Straits of Hormuz, they dismissed it. Not going to have much effect at all, maybe a short-term blip. Well, it's looking a lot more than a short-term blip, isn't it? And that's what I want you to think about, because the leaders of the United States, I feel, are suffering from gross overconfidence from their recent exploits in Venezuela, which is now running through to Cuba, because Cuba was almost totally reliant on Venezuela for its supplies of oil, and that is now controlled very much by the yay or no from the United States. And they're letting some oil into Cuba, but not much. Think of the players in this game. We know all about Americans, we know all about Israel. On the other side, you've got the Iranians, who are ruled by a modernist theocracy, ruled by the mullahs, and that's been going since the Shah was ejected by a popular revolt stirred up by the CIA, which was 47 years ago now. It's a long time. And Iranians, on my observation, are very well educated people, smart people, and historically they're warriors. Iranians, at one stage, the ancient Persian Empire, they were the hegemon of the world. They were the rulers of the known world for a long time. And that tradition is deeply embedded in them. And the Persians identify themselves very much by their martial culture, not anymore on archery and mobility, but still mobility. And modern Iranian forces, often referred to as warriors in rhetoric, continue this culture of aiming for deterrence through resistance strategy. And they've had 40 years to think about this and to think about their ultimate weapon, their geography, their easy control of the Straits of Hormuz, which are a choke point for shipping, with 25% of the world's oil coming from those Gulf countries and having to run the gauntlet at the Straits of Hormuz, which is very easily controlled by Iran. Think also of this as a continuation of the ongoing conflict between the Sunnis and the Shiite Muslims. There are two main branches of the Islamic Muslim culture and religion. There's the Sunnis, who comprise about 80 or 90% of Muslims worldwide, and the Shiites, who are about 10% of the Muslims worldwide. But Iran is a very special case because it's been run by a theocracy of the religious leaders since the Shah was deposed 49 years ago. And these people are often referred to as zealots, as extreme Islamists, and those sort of comments are accurate, but they're also partial. Iran is a proud country. It's a big country. It's got 90 million people. This is not some spot on the wall. This is a major, major industrial and military country. So think about the general situation of financial markets. Equities are not far off historic highs. They've been overdue for a correction for the whole of this March contract in futures, and that expires tomorrow. Tomorrow's rollover day, the end of the March contract in futures. And often enough, for those of you who are historians of financial markets, major trends can sometimes end on rollover dates. And if we think of the behavior of equities in particular, because it's so visible there, that for months now, this market's been going up and down and up and down in a range which is pretty much defined by massive hedging positions, both above and below the market. And the current volume and commitment by traders has not been enough to break either of those choke points. So you have markets going up into resistance, running down to support, and the buy the dippers, which essentially, don't forget, our retail players, have been having a field day buying every dip. And that's ending now. The enthusiasm for buy the dip was very absent today in the market, as some of you would have noticed. And that's a big overhanging burden on other markets as well as equities, because they're so vital as a historic leverage of product, of wealth, what have you. And there's a lot of other things going on for you to think about. One is the ongoing battle, if you like, between AI and software. And AI is eating software's lunch, and then some. And there's massive, massive weakness in the software businesses because of the perception, in some cases the actual fact, that AI is doing that job and more. And in the private credit market that I warned you about a month ago in our last webinar, Trade the Mania, the vast amount of weakness in the private credit market is caused by investment in software funding and insurance companies. It's estimated 35% of the investments of the major software companies, of the major private equity promoters and managers, is in software related stocks. And that's a huge amount. And credit markets have been shuddering and showing some radical repricing from inside the private credit market. And we've seen some cockroaches in this market. A month ago at our last webinar, and I apologize for missing one or more in that time, have been looking at the point that there's always more cockroaches. And it started with the troubles in Blue Owl, which I talked to you about at length at our last webinar, and has now, of course, spread to the majors, including BlackRock and others. And we've got the incredible situation of a very, very major funder and manager of these private equity instruments reassessing in a 3-month period a product that they had valued at 100% safe, and they'd written it down to zero, literally in 3 months. And this is a major, major player. This is BlackRock. So is that going to find more movement elsewhere? Undoubtedly. There are always more cockroaches when there's trouble. And that's the case here. They're coming out of the woodwork. And it's not something new or different. I've been telling you over the years, many years, we've seen this. Those of you who've been interested in markets long enough will remember the 2007-2009 crash was almost exclusively caused by mispricing and misvaluation in MBS, the mortgage-backed securities that were so dominant in that particular game. And human nature is such that when promoters and investors are allowed to make their own valuation of a security, they're optimistic. They're always optimistic. And of course, the basic comment about almost everything you will read here or learn about trading is that proponents talk their own market. They're talking their position. They're talking it up. And when you get a situation as in private credit, which is now a $2 trillion industry, it's huge, grown so fast. It's very called private credit for a reason. It's very private. It hasn't seen the light of day very much. And it's taken a pretty massive disruption to private credit to bring out the ones who've been a bit too enthusiastic about their valuation, and that we're talking about a lot of money. So inflation in the Western world is roaring. I've been telling you that consistently since 2004. Markets have unfortunately learned that they can listen to government, and government, of course, are the ultimate proponents of talking their trade, and that is that, yes, inflation's under control. Well, inflation hasn't been under control since 2004, when I first started talking to you about it, and it's roaring. Real inflation is multiples of what we're being told the official inflation rate is. But you have to understand that official inflation rate is wholly engineered. It's designed to be smooth and changes to be gradual by the simple expedient of removing most of the volatile markets from the calculation of inflation. Energy is not included in the valuation of the official valuation of inflation. Housing is not included. The cost of the supermarket, which we all live with, is not included. In other words, when you take out the big movers and the products that are so universally used by all of us, you can get that figure to say pretty much whatever the spreadsheet wants. Keep thinking about what's happening in this war in Iran. 6 days of war has cost about $11 billion. Wow. That's a real cost, and it's now many multiples of that, undoubtedly. And Trump's demands have him in a pretty extreme position in regard to Iran. He has made demands similar to the deal that the US managed to get in Venezuela, that the leader of the country has to be acceptable to Trump. By definition, that means do what America wants, or Trump's version of America wants. And it's not that easy. And Trump continuing to declare that they already won the war, they won the war, we've won the war, is not actually correct, because of this sleeping issue that's been there all the time. Everybody's been aware of it for decades. It's been talked about for decades. And of course, the Iranian people and its leaders in particular are well aware of imposing a cost. In other words, they don't have to actually win this war. They just have to make it unbearable, particularly to the United States, by raising the cost of this war. And the ultimate cost is going to be what's happening now in the Straits of Hormuz. 25% of the world's oil has to transit the Straits of Hormuz. It's only about 32 miles wide. It's terribly easy to control shipping through there for a hostile nation. Ships are pretty much, big ships are pretty much by definition a controlling entity's dream. They're large, they're huge, they move slowly, they can't disappear. They emit all sorts of electronic signatures, whether you can see them or not. sophisticated countries know where they are. They can be tracked. And it comes right down now to this basic issue that Iran has imposed a blockade at the Straits of Hormuz, said they're going to continue it. And how can America and Israel control what's happening in the Straits of Hormuz? In my view, they can't control it without a great deal of difficulty. And I don't think history will show that you can actually impose regime change, which is essentially what the Allies are asking for. You can't control a regime to the extent of regime control, which is terminal ending, in effect. By air power, you have a situation now in Iran, been the situation for a while, that the United States and Israel have complete air superiority, complete control of the air, allowing them to send in their biggest bombers that are vulnerable to sophisticated defenses, and they've managed to impose, excuse me, complete control of the air around Iran. But you can't inflict regime change through an aerial combat scenario on its own, or on a naval blockade or destruction of naval assets on its own. You really have to have at some stage to control that area of Iran that is within a drone or a missile striking area of the Straits of Hormuz with boots on the ground. And that's a serious no-no for Americans and their allies. We all remember Vietnam, or most of us of this age remember Vietnam only too well. And the Straits of Hormuz, SOH, it's too easy to control shipping in the SOH for Iran. It's a fairly simple issue that they've got sophisticated mechanisms. They've also got a lot of basic unsophisticated mechanisms like fireboats. They're not new. These are remote vessels, quite small, that they can steer remotely onto shipping targets and light them up. And that's what's been happening. And in that issue, you can see that you've got the Sunnis and the Shiites who've been at each other's throats since 1400 AD. Excuse me, the death of Muhammad, the prophet to Islam. And that's exactly what's happening now. When you were wondering why Iran is spreading the war to so many of the other Gulf countries, almost all of whom are Sunnis, the majority of Muslims in those countries. There's no love lost between the Sunnis and the Shias. They've been at war in one form or another since, as I say, 1400. And I talked to you about all of this at our last webinar, which was the 19th of February. And there are the points I made then. Stocks are generally at mania levels. Private credit is looming drama for securities. Losses in private credit see securitization means runs on the banks that have financed a lot of this money. Huge losses in insurance companies, as private credit is now 35% of long-term investments. Just follow what has been happening in these markets since our last webinar. Now, I told you that almost a month ago, and it's all been playing out, unfortunately, pretty much the way I thought it would. This is what's happening in the market recently. This is a Bangkok flagged general goods carrier on fire in the Straits of Hormuz. The Iranian military came up with a statement and said, we've sunk 3 ships, attacked 3 ships in the Straits of Hormuz, and they were all warned by us that that they shouldn't try to transit the Strait, and they didn't ignore their advice. So we've attacked them. And not only this, there's a whole lot else going on around the region. This is a different Gulf tanker that's been attacked. Some have been attacked in the Mediterranean in this extension of the Sunni-Shia conflict. And what Iran's trying to do basically is make things so unpleasant for all of the other oil-producing nations that they bring weight and urgency to demands that the US stop these massive attacks on Iran. Something else to think about. There's no such thing as ETFs. The dyslexic zone has struck again. I'm talking about exchange-traded funds, which I call the dumb money. For those of you that don't know about ETFs, basically what's happened and been happening for many years now is that, particularly in the US, the culture of stocks trading is very well known, very well understood, a very traditional investment for Americans. The promoters behind various individual ETFs came to the conclusion that trading options or futures in particular was very hard. You had to learn how to do it. You probably had to pay someone to teach you how to do it. And it was not for the common man. And with that view, they came up with the idea of taking the equivalent of the major options and futures markets and turning them into something that looked and smelt and traded like an ordinary stock. So they can take away all of the mystery, the drama, the excitement of options and futures in particular, and we can create an instrument that makes traditional indices operate as a single stock. In other words, you can have a price for the day. You can buy or sell once a day. Keep it as simple as you can. And this has been very attractive because there's a whole lot of people who are interested in markets, but they're essentially dumb. And dumb people go to ETFs. I'm sorry to offend any of you if you're an ETF player, but basically, not only are they the dumb money, they're now the dominant money. And that's an incredible thought. But ETFs on many occasions now have more volume in dollar value than the futures markets. Quite extraordinary. We talk more about it as we go. So for those of you who are not news hounds and following every move of what's happening around the world, this is what the Strait of Hormuz is all about. It's a choke point on the southern side of Iran, and you've got Iraq and Iran on one side, plus Kuwait, Saudi Arabia, Qatar, UAE, and a lesser extent, Oman. Oman, I think it's pronounced. And that passage of water, where they get pretty narrow, is only about 33 miles wide. Easy targeting from either side. But of course, the threat comes from Iran. It's their defense. This is their ultimate defense to impose financial ruin on the great Satan, as they call America, and the lesser Satan, as they call Israel, and all of their Shia, all their Sunni cousins around this area. And that's the tanker choke point. That's what it's all about. And it's just too easy to have some missiles in Oman sitting there targeting a really simple, obvious target. Huge ships sailing very slowly, can't move terribly far when the waterways are so narrow. So this is the key route for global oil transport. and it's being squeezed. In fact, it's being closed at the moment. And that's what we're talking about when I make these sort of comments to you. As well as that, Iran has some very strong proxies that act pretty much on its behalf. One of them is called the Houthis, and they are in Yemen, right at the south area of Saudi Arabia, with big waterfront frontage, and they've already shown, because they've been running periodically a war of harassment against basically Israel and any countries that identify with Israel, and they've been able to show that by a very limited number of maritime sinkings, shooting 6 ships as they go through the south of the Red Sea, they can impose a blockade at an outbursting of fear and caution very easily. And of course, their weapons are supplied by Iran. They're a proxy for Iran. They're closely tied, and they're sitting there at the south of the Red Sea. Now, some countries, Saudi Arabia in particular, they've got a massive pipeline running east-west across the belly of Saudi Arabia. And they can pump oil through that and harvest it in the Red Sea. But they've got a problem there because you've got the Houthis who are capable of attacking them. That's another choke point. And going north, of course, you've got Suez Canal. And not all the ships that are oil tankers can get through the Suez Canal. You have a class of ships called Suezmax, which are transport ships, mainly oil tankers, that are built to allow them to go through the Suez. You have another class of ships called Panama Max. Same thing, they're built to ensure that they can go through the Panama Canal between North and South America. And you've got this incredible vulnerability with these fat, explosion-prone, highly flammable tankers being controlled by Iranian-supplied missiles and other war products. Huge problem. This is a little map to show you again, for those of you that are not avid readers of news. This is Yemen. Now, Saudi Arabia, with all its power and sophistication and access to super advanced weapons, including all of the US military aircraft, etc., it had a war with Yemen for years, fully supported by the US, and they really couldn't do anything about it. And the Houthis are still there. And America's had a campaign against them, try and control what's been happening in the Red Sea. Same issue, they're still there. They still have weapons supplied by Iran. They're still capable of targeting shipping. And this whole thing is just conflated. And this is what shows you a little bit of the tentacles, if you like, of the octopus that is Iran. You've got Hezbollah. You've got Hezbollah in Lebanon. You've got a number of pro-Iran organizations in their neighbor Iraq. You've got Israel, which is the little Satan. It's the prime target of what Iran is doing here, as well as, of course, the US is. You've got the Gaza Strip with Hamas in there and Islamic Jihad. And in Yemen, you've got the Houthis, all of whom are incredibly hostile to Israel and to the United States. So it started back when I talked to you about Blue Owl, the first to face massive redemption demands. Now, the next few slides come straight from our February 19th webinar. And for those of you who missed that webinar and not aware of what's going on there. This will bring you up to date. But the first crack in private equity was experienced by this firm, Blue Owl. And I told you about that and what happening with that. And recall the immortal world from Margin Call, the movie. If you haven't seen it, folks, move heaven and earth to find it and see it. It's a great entertainment for you that don't have any interest in financial markets. But for those of us that do, it's a thinly disguised statement of what happened in 2008, 2009 with the MBS crisis that caused the great crash into March 2009. And the immortal word, the only way you can, this was taken about a mythical company thinly based on Goldman Sachs, I suspect, where the elder partner who was in charge of putting out fires said that to succeed in this business, there's only three ways: be first, be smarter, or cheat. And that has been just carried out again and again through the history of markets, of which I'm a immense student. And for Blue Owl, they were first. Be first. That's your salvation. And the corollary of that is it goes on. And as I said to you, deja vu. We said this could be Blue Owl's be first moment. Sell it all today, and especially if it were to later emerge that the secondary market is only deep for higher quality private credit assets, and that's turned out to be true. And this is precisely when the margin call moment of the private credit sector happened, because what happened next would make the market's head spin. This was the be first moment, and now all the others have realized that they are too late. It's that simple, isn't it? Wonderful stuff. Be thinking about this. There's nothing new about it. We're seeing this same situation run out again and again and again. Only this time it's RMBS and CMBs, the securitization forms of mortgages. And let's see what happens from here. So what mania was I talking about? This is another slide from our webinar on February the 19th. You've had a month to learn about this stuff and soak it all in. What mania? Dow's making new all-time highs on 18th of February. Australia's SPY index makes a new all-time high that week. South Korea's Kospi is making new all-time highs. It's been on an absolute roar. All US equities are hovering near their record highs. Credit creation is massive, and private credit is at all-time highs and expanding rapidly. And this is the continuing AI debate that the stock market turmoil unleashed by the artificial intelligence industry reflects two fears that are increasingly at odds. One is that AI is poised to disrupt entire segments of the economy, so dramatically that investors are dumping the stocks of any company seen as being at the slightest risk of being displaced by the new technology. And the other, which is now gaining much more course and much more interest, is a deep skepticism that the hundreds of billions of dollars that tech giants, who know the usual suspects, are pouring into AI every year will deliver big payoffs. And there's a lot of people now starting to think that is maybe not going to be so. So an analyst from Nomura said those two things can't be true at the same time. Well, it doesn't actually even matter whether they're true or not. It's the perception that counts. And there's a growing perception that AI is going to harm much of the also historic software investment that has been happening. And this shift of sentiment that AI would set off a transformation productivity boom kept pushing stock prices higher. That's been the main narrative for many years. and the results of those companies shows it. Meta surging 450% from the end of 2022. Alphabet up more than 250%, etc., etc. And that began to change last month. Earnings reports from some of the biggest tech companies started to spook investors who are growing impatient that the spending has yet to produce a commensurate windfall in revenues. I've talked to you about that, so if you can read this here. You're talking about these giants of the business expected to spend more than 600 billion with a B on capital expenditure in 2026. Well, they don't have that money, quite frankly, and that's spooking the AI industry. That's a source of weakness on the existing narrative. This is the whole argument about mark to market. When you don't have available markets against which you can have a valuation which has been tested vigorously, the inclination is to do your own valuations, whether it's from a friendly external source or from your internal source, which makes the whole concept ridiculous. But this is the historic reality. I've been seeing this thing, I don't know, since well before the 2000 top, in that whole run-up to the dot-com end of the dot-com bubble. That's exactly the same thing. There's nothing new. There's nothing new under the sun. It's the same thing as what happened at the 2007 top in equities. Phony valuations, deliberately or otherwise. Some of them are just caused by enthusiasm. Circumstances change and you've got a fixed security position that was created in different times. So this whole growth of private credit started when in August Trump signed an executive order titled democratizing access to alternative assets for 401k investors. And that directed regulators to make it much easier for your retirement savings to flow into private credit, private equity, and other alternative assets. That would really be the turbocharge to the already existing massive growth in private credit. They go on to say investments in retirement plans. Apollo, Blackstone, Goldman Sachs, State Street, they're all racing to launch private credit products for your 401k. But here's the problem. Private credit is showing cracks at the exact moment they want to open it up to retail investors. Always the way, isn't it? Top of the iceberg. This is a story about BlackRock TCP Capital, one of the largest publicly traded private credit funds, plunged 17% after disclosing a 19% write-down on its net asset value. Can you think about that? Almost 20% decrease in value of its net assets. Biggest drop in 6 years. This is BlackRock, the world's largest asset manager with $14 trillion in assets. And if they're taking hits like this, what chance does your 401 have? Private credits ballooned to over $2 trillion in assets. For years, it was the domain of sophisticated institutional investors, pension funds, endowments, insurance companies. These investors have teams of analysts, lawyers, and risk managers to evaluate complex deals. Your average 401 participant doesn't have any of that. Once again, it's the Muppets who are going to pay for it. That's what happens. This is an reasonably up-to-date 2 weeks old US fundamental long-short alpha returns. That's option code for profit. And you can see that's all pretty interesting. Andre, good on you, mate. You're a wonderful man. Big Danielcode supporter says, "Hey John, it's ironic. I just watched the last 30 minutes of The Big Short. It's all there. It's all history. There's nothing new. It's all the same under the sun." So this is the story of Blue Owl, which was the start of the obvious problems in private credit. And I say obvious only because of history. We've seen this act again and again and again, and it always ends the same way. Too much enthusiasm and not enough critical thinking. Well, there was a whole page of no critical thinking. So to understand more of why markets do what they do, you can teach yourself to trade. It's a wonderful industry, folks. I've been in it for half a lifetime. I thoroughly recommend that you do this. And one of the easiest ways to do it is our Teach Yourself to Trade, TTT, video series. And they're a series of reasonably short videos. They're all less than 90 minutes that teach you why markets do what they do and how you can take advantage of the fact that with Danielcode, all markets trade the same according to Danielcode ratios. Now, that's a big statement to almost all of you, and certainly the industry. They are embedded in the concept that markets are so specific to themselves. In other words, what happens in oil has got nothing to do with what happens in precious metals. What happens in soybeans shouldn't affect what happens in gold. But the reality is, well, all markets are related in a minor way. Some of them are related in a very, very major way, but they all follow the Danielcode time and price ratios. And I want you to think about that for a couple of minutes, because the world is absolutely afloat with wonderful, wonderful trading programs promised to you, and a deep belief that technology, including AI, can deliver you the holy grail of a safe and successful trading program. The reality is it doesn't. And if you hear that argument about one particular sector of the business, it should really apply to every sector of the business. So unlike almost anyone else, we cover 9 future Forex contracts, I should say, and 11 or 12 futures contracts. And as I'm going to show you, they all react exactly the same to the Danielcode ratios, which define all markets in every time frame. Then that's a huge statement, and I'm going to show you some of that as we move on. So this is the US dollar index long term. This is going to be a huge player in what's coming out of the Iran war. And since 2022, well, long before that, it's been commented on as the end of the dollar, the end of the dollar. It's not happening. You can see these. This is a really long-term chart. Every bar here is 59 trading days, which is essentially 3 months of trading. And you can see how this market's found its support at the Danielcode number of 95.035, exactly within a handful of ticks. And it's been spent the last 4 months finding that level and holding that level. If we get a break of that, which I believe is unlikely, I think the US economy is underlying what's happening in some of the securitization issues. It is incredibly strong. I think the dollar continues to be a very, very safe and worthwhile investment. Have a look at what I'm going to show you now. I'm going to show you every Forex market that we cover, and all of the futures bar one that didn't, might have even been 2 that just haven't moved enough to show you anything interesting. But this is what you're getting from the Danielcode charts, members charts, which we publish twice weekly, sometimes 3 times a week, sometimes every day when markets get seriously volatile, as they're going to go very soon. Have a look at them. Here's the Aussie US dollar. There's its last Danielcode sell. What happened? Down goes the market. We're short. Here's the euro yen. Had a sell signal for today. What happened? Market went down. We're short. Here's the euro US dollar pair, just referred to as the euro. We had a Danielcode sell signal 2 days ago when this market did a key reversal bar right at the minor retracement of 108.551, and we're short. This is the British pound US dollar. Same thing. It did a key reversal bar at 138.84. Key reversal bars at known Danielcode price targets are powerful, very powerful. And you can see that all the time, every day on our members' charts. And funnily enough, not a lot of you actually subscribe to our members' charts. They're very cheap. We haven't raised the price on them that I can remember for many, many years. But this stuff is absolutely vital to your trading. And you can see how every one of them, I'm not cherry picking here, it's every futures market bar one or perhaps two, and every Forex market. And they're all doing the same thing. You'll get bored to death with the repetition. Have a look at it. This is the Kiwi New Zealand US dollar pair. Danielcode sell from a key reversal bar at a known Danielcode target of 59.67. The high of that bar was a handful of ticks away from that number, and down it goes. This is the dollar CAD, the loonie, so-called, in the recognition of Canada's national emblem, the loonie bird. We had a DC buy signal 2 days ago. Up it goes. We're long. Dollar yen. Very important, huge market. This, of course, is the carry trade market. And I just want to show you here how specifically good it is. We had a sell signal. Didn't go much, but it gave us a key reversal bar again. And then the long signal yesterday has given us 2 days up very nicely. Have a look at these 1 bar counter trend buys. For those of you who've done the Danielcode tutorial, you will remember that whenever you're stopped out, you have 3 methods that have permission for you to re-enter the market with the trend. And the first one is a 1 to 3 bar counter trend. And these 1 bar counter trends have a life of their own. Have a look at them. 1 bar down, goes through the failure point, market rallies, does it again, same thing, does it again the last 5 days we've been in, same thing. All markets repeat, but they all repeat at their Danielcode numbers. Look where today's close was. Nice big day, second day of a buy signal. Where's the close? Almost exactly on the Danielcode blue line. And you know about these blue lines, folks, days, weeks, and even sometimes months ahead of when the market's tracked as a Danielcode target. This is crude oil, of course, which has been a source of great joy and entertainment to all of us, hasn't it? 42,000 in that long trade from a flip me buy after a failed Danielcode sell. Really interesting to look at. The range, I've been saying to you, the daily range of these markets is astonishing, and that's what's attracted me back to day trading again. The dollar value of these daily trades is just too much to ignore. We had a buy signal yesterday, elected today from the inside bar. The range of that from the low to today's close, almost $7,500 per 1 contract. I mean, you just can't turn up your head at those sort of levels of risk. And gold has been doing the same for a long time. Equities are going to have their moment very soon. Some of the other commodities have been the same. This is the S&P. Key reversal bar at a known Danielcode target, 68.51. Down it goes, $3,800 in 2 days. Nice trading. The intraday trading of that value is almost twice that. Here's gold. We had a sell signal for today. Collected, down goes the market. Natural gas had a buy signal with it right at its target. The low of Tuesday is almost exactly at 2961, just a handful of ticks variance. That's what you get with the Danielcode: target recognition and target variance, which sets up the trade for you. 2 days up, we're long, been long for 2 days. Very nice, it's sweet. More importantly than all of this, folks, not every one of these trades is so brilliant at the time. Some of them are going to take a few more days to go through what they are going to go through. But in the invitation to this webinar, I tried to point out to you that once you get in these massive market moves, the most important thing is to be on the right side of the trade. There'll be times when a short-term focus is great. There'll be times when let it run is great. But if you are getting an understanding of the Danielcode, you will be on the right side of the trade almost all the time. It's extraordinary. The Danielcode website's been public since 2007. Long time we've been doing this, but it's always the same thing. Trades to and from Danielcode targets, which we know about, which we publish, and they're easy for you to access. Here's the Russell, which I've been telling you pretty much all year is the best of the equities market to trade. You have a classic Danielcode buy right at a reversal on the blue line. I don't know if you got into that trade or not. You'd have to be an intraday trader, which I've been telling you you should be. And then we had a sell 2 days ago, just a touch to get elected on Wednesday, and nice day down today. Pretty interesting stuff with the weekend coming up. This is soybeans, success buy in there. By correlation, there gives you a DC buy, a big bar up with a gap, and then today straight into the Danielcode blue line target, and then ran away. So not much value in that trade, but I'm showing you that same thing that all these markets do, responding and reacting to the Danielcode blue lines and red lines, which control all markets in all time frames. Here's wheat. We had a nice multi-day run up, huge big blow off, top into a key reversal bar at our blue line target of 642. Another bar down into a Danielcode buy, almost exactly this red line support at 584. 2 days up. Key reversal bar down today from the $612 mark. Okay, these are not actually great winning trades, all of them. Some are, most of them are, but you're always on the right side of the market. And that's going to be key for what you're going to be faced with very, very soon. To explore that just a touch more, I've shown you this chart, which comes from the 8th of March. This is the members chart. This is what we post on the 8th of March. Have a look at the black line numbers, which are, you've got to squint a little bit to see them. You've got the first one that was approaching that market was 114.29. That little arrow sign you see is called a correct. So you've got 114 points and 29 ticks, 32 ticks in the for a point in the long bond. 114.29, one of the Danielcode black lines. Below it, another Danielcode black line at 114.11, and below that 114.02. And this is a chart we published actually before the 8th of March. This goes back months, you can see these numbers. But this was the second most recent version of it. Look at those numbers again: 114.29, 114.11, 114.02. This is the market at the end of today. Danielcode sell for a big key reversal bar at the blue line at 119.05, down to a little 1 bar counter trend rally, which failed. Sets up a Danielcode sell signal. Look where these lows have been. Today, the low was at that black line, 114.02. Wednesday's low was at the previous black line of 114.11. How accurate are those numbers? Well, Wednesday's low was 114.13. Correct. 114 correct, 113. In other words, one tick away from the absolute blue line number. Today's low 114.02. Straight to the second black line number at 114.03 for the blue line, and the black line at 114.02. In other words, zero variance, exactly at that black line. One tick, just one tick from the blue line. How accurate? This is what happens all the time. There is nothing new under the sun. Things will be as they have been. What has been is and will be again. Okay, things to think about. If you haven't, folks, already had a free trial at the Danielcode, please go ahead and help yourself to a free trial. The more you learn about Danielcode, the better trader you will be. Just simply go to the website, click the button for the free trials, and follow the prompts. If you have any problem with access, do contact Terry at support@thedanielcode.com. He will be happy to help you. And finally, of course, our disclaimer, our statement that trading of derivatives is very risky if you don't know what you're doing, and you will lose your money very quickly. The good news is that once you do know what you're doing in a Danielcode way, it will be very successful and you can make a lot of money very, very quickly. So the best advice I can give you is get educated, because the storm is here. And the more you know, the more money you're going to make. And that's me for today, folks. As I say, for those of you who've written to me, I've had a couple of cataract operations. They're absolutely marvelous, absolutely wonderful. I'm thrilled to bits. I'm on the way to getting over some of the side effects of the anesthetic, etc., which as you get older, we know healing is a slower process. And to actually find out how slow that process is was bloody awful, but it's over now. It's all on the good path now. So stay well, folks. You've got a really, really exciting trading times coming up. Massive, massive options in front of us, all of which Danielcode will show you about and keep you on the right track. Okay, David's with us. Yes, that's fine, mate. Good to see you. Jeff, thank you so much for being with us, Jeff. Hope you're enjoying your trading. Andre, the same. Good night, my friend. For you, good day. For me, it's 11:35 a.m. On Friday morning down under, and it's a beautiful sunny day. Lovely. It's still warm. It's still warm here as we head for the start of autumn. Take care, my friends. Do write to me if there's anything in particular you'd like me to talk about. jneedham@thedanielcode.com, and I'll be happy to put something together for our next webinar, where I will look forward to seeing you again. For now, it's bye-bye from me. Enjoy your weekend. Enjoy Friday night trading. And remember, tomorrow is rollover for equities. All of them, the biggies, the ones you're interested in, and major trends can sometimes end at contract rollover. Bye-bye for now.